So the question is breaking your mortgage for a lower rate, is it worth it? So in this environment where we have had high interest rates for the past 2-3 years and people getting mortgages at 6 to 7% at a fixed rate, this question is being asked a lot. I've seen it in the IIT group as well, where a lot of people have asked if breaking the mortgage makes sense for them. Especially when they have to pay some penalty for it, right? So today I thought I'll bring you to the forum and see if you can debunk this for a lot of people, the myths around this, and then break it down by presenting some case studies, and so that we can understand what goes into breaking the mortgage and what are the questions or factors that we should look at.
Absolutely. That's been the burning question for a lot of people who bought their houses last year. Most of them ended up getting an interest rate of 5.5% or higher, some even close to 6%, and some even higher than 6%. Now, everyone wants their mortgage payments to be lower. And now we are seeing the interest rates coming down as well, both fixed and variable. The fixed rates have come down steadily over the last 1 year or so. Mm-hmm. And variable rates obviously have been in more news in the last few months because of the rate cuts that have been happening,
right?
Which is making a lot of people question their choice of mortgage. When they signed up for a higher rate of interest last year, should they continue being on the higher rate of interest or not? The answer, well, it depends, because when you break your mortgage, you are liable to pay a penalty. Mm-hmm. Your penalty is dependent on whether you are on a fixed mortgage or a variable mortgage. Mm-hmm. And if you are planning to break your mortgage and move to a lower rate of interest, does the lower rate of interest or the lower payments justify the penalty or not? That is the question you need to answer before taking the plunge into breaking your mortgage or not. So it's very simple. The penalty with a fixed mortgage is usually interest rate differential or 3 months of interest. But what we are seeing right now is most of the mortgages that were taken on a fixed rate of interest last year are still on a 3-month interest penalty.
Okay.
Which is a great thing for the clients, because then they can think about actually breaking it and moving to a lower rate, because the savings may offset a lot of the penalty in the next 1 to 2 years itself. Mm-hmm. However, if interest rate differential kicks in, then the penalty can be very, very high.
But this is a really interesting point you mentioned here. Even for fixed rates, we are having 3 months penalty only at this point. Huh?
That's a very interesting scenario that we are in right now, because most penalties on fixed rate mortgages are calculated on posted rates. Mm-hmm. However, the interest rates have been coming down. The contract rate interest rates have been coming down, not the posted rates. It's only a matter of time when the posted rates will come down, then the interest rate differential penalties will start kicking in.
Oh, okay.
Yeah, so like we were discussing, a lot of people got their mortgages last year, and the rate of interest is in high 5s or early 6%. Mm-hmm. Depending on whether they had an insured mortgage or an uninsured mortgage, their payments may vary. Right? Let's take a case of an insured mortgage where the mortgage balance is, let's say, about $700,000, and their monthly payment is about $4,500.
Okay.
It's very likely that their penalty to break the mortgage is going to be 3 months of interest, which comes out to about $10,500, depending on the lender, but more or less in that ballpark. So let's say your mortgage amount was $700,000, your monthly mortgage payment would be close to $4,500. Mm-hmm. Your penalty right now with most lenders, again, no fixed rule here, but you need to call up your lender and try to see what the penalty is going to be. But most likely it is going to be 3 months of interest, which comes out to about $10,000 to $10,500. Now, if you decide to break your insured mortgage, you are liable to pay this penalty to the bank as well. Some people may not have the money upfront for an insured mortgage. You need to pay this upfront to get to move to a lower rate of interest.
Okay.
Let's say
so you cannot bundle it into your mortgage, but you have to pay upfront, right?
That's correct. In most insured mortgages, you might have to pay this upfront. You can only bundle it if you have, if your property value has increased in value, mm-hmm. Or you've paid down enough equity to have 20% or more equity in the house. Okay. If you did let's say a minimum down payment, about 10% down payment, it's very likely that in the last 1 year or so, you've not been able to build up 20% equity in your house. So coming back to the point, let's say you decide to break the mortgage of 6% and move to a lower rate of interest, 4.2% for the sake of assumption. Your new mortgage payment would be close to $3,800. That's a saving of almost $600 to $700 in the monthly payment. The penalty that you have to pay upfront would be about $10,500. The lower monthly payment would mean that you pay less towards your interest and you also pay more towards your principal in the coming pay cycles. At the end of about 2 years, you will have a total benefit of close to $32,000. That's a huge amount. But you need to pay $10,000 to access this. Now, I spoke about this scenario of moving to a lower fixed rate. You can also decide to move to a lower variable rate because variable rates are also lower than the current fixed rate that you might be on. And if you decide to move on a variable rate, it depends. You choose a adjustable rate mortgage or a variable rate mortgage because both options work differently. For an adjustable rate mortgage, your monthly payments will come down with every rate cut, which is what a lot of people are expecting. And that would help you manage your cash flow better in the coming months.
Right. But variable rates do come with a risk, right? Like there is a difference between how you go for a fixed and then variables are on a trend of reducing now, but it may, we never know, right? So what are some of the
100%.
risks you would say with the variables?
So the biggest risk of variable is obviously it going up. Bank of Canada and most other big banks are projecting that there are going to be 3, maybe 4, maybe even 5 rate cuts in the coming few months. But what after that, right? If you move to a fixed variable rate of interest, you will have to take at least a 3 or a 5-year term, right? We know that, let's say, for about a year or so, the interest rates would be coming down. So your payments might also be coming down if you're on adjustable rate mortgage. But after 2 years, the rate of interest can go up as well. So that is one risk that you should be ready to sign up for if you are looking to move to a variable mortgage.
Right.
And let's take another example. If you have an uninsured mortgage, for an uninsured mortgage, that means you pay 20% or little higher in your down payment when you bought the house. This in this scenario, you are able to take in your penalty, the $10,000 amount, and add it back to your mortgage. So, for example, your mortgage balance was $700,000, and your penalty is $10,000. $10,000. Because you have 20% or higher equity in the house, you can add back this $10,000 into your mortgage balance and save the money upfront. So you don't have to pay out of pocket to move to a lower interest rate.
Right.
Good option, great option for people who are in a position like this. This would also result in a significant savings. Let's say you started at 6%, your monthly mortgage payments around $4,200. We're talking about 29 years left in the amortization overall. From $4,200, you can move down to about $3,600 at 4.5% fixed rate of interest. That's a monthly saving of almost $600 again.
So this is a similar saving. We're taking the same rate, 4.2%, which we took in the previous scenario.
Yeah, in this case, I'm taking a slightly higher rate of interest, 4.5%, because uninsured mortgages generally come with a slight premium of 0.25 to 3%, depending on the lender. And yeah, your total benefit again comes out to about $25,000 in the next 2 years. So end up adding back your penalty into your mortgage. You pay less towards your interest and you pay more towards your principal, giving you the rate. Now we've discussed the scenarios where moving to a lower rate of interest makes sense. But when would it not make sense? So it would not make sense if your penalty was $10,500. The savings that you get in the next 2 years or so is less than $10,500, or insignificant. Let's say $11,000 or $12,000. It's not worth it in that. So numbers need to make sense. You need to see if the potential benefit is way more than the cost that you incur to move to a lower rate of interest.
Right. Doing it with the same bank a better option, or switching it, going out and looking at other lenders also is something that you would recommend?
That's an excellent question. So, uh, if you go back to the same lender and understand what options are they giving you of both moving to a lower fixed rate or to a variable rate, uh, that is the easy route, because in that case you don't have to initiate another application, you don't undergo another stress test as of a new mortgage with another lender. Uh, but the downside here may be that you may not get the best offers from the same lender. Uh, but like I said, it is the easiest thing to do. You just need to call up your lender, understand what your penalty is going to be, how much are they going to charge you, or what is the overall cost going to be, and just sign up. It is good to go from the very next day. Practically. If you were to move to a different lender, then obviously you need to evaluate. First of all, you need to evaluate why do you want to move to a different lender? Is it because of a specific product? Is it because of maybe a lower interest rate? If that is the case, then is your mortgage insured? Is your mortgage uninsured? If your mortgage is uninsured, you need to be ready to pay the penalty upfront.
All right.
And into a new lender means a fresh mortgage application, fresh credit pull, fresh qualification, fresh stress test. So
It's more.
you need to understand.
It's more work, and it needs a lot of effort, right? To know why you're moving, basically, as you said, right?
Exactly.
If you know that, and if your potential savings are more, then it might be worth to take all that steps, right? Take those steps.
Exactly.
I think we got a question from Anmol here. He's saying, can you please explain the reason why the penalty is not adding to the mortgage in case of insured mortgage?
Yeah, for the simple reason that you are with an insurer right now. Insurer signed up for the original mortgage amount. And if you are breaking the mortgage and moving to a new lender with an insured clause in it, you cannot, you need to actually pay out the insurer. If you're not doing that, you're transferring that insurance from one lender to another. And in that case, you cannot change the mortgage amount. If you cannot change the mortgage amount, that means your penalty needs to be paid upfront. When you are in an uninsured mortgage or a conventional mortgage, this switch over from existing lender to a new lender can actually be considered as a refinance. And then the penalty can be added back to your new mortgage balance. So that's the simple reason.
I hope it helps, Anmol. Okay. I think there were other questions, like what is generally, are there any charges that are associated when we are switching? For example, we're trying to register a new mortgage now.
Yes, there are some charges. The biggest charge, obviously, is the penalty. The second charge that you need to be prepared to pay is a transfer fee or an FCT fee, which is basically used by a third party. We use a third party to move your mortgage from lender X to lender Y, and this results in a title transfer from lender X to lender Y. There's a fee involved. You can also get a lawyer to do it for you. But if you're using this third party service, then there's a fee for them, about $700 to $800. It may be a small discharge fee, $100 to $200 discharge fee from your existing lender. Depending on the lender you are with, they may also have a reinvestment fee.
Okay.
So overall, apart from your penalty, you're looking at a total cost of about $800 to $1,000 on top of your penalty as well.
Okay.
This fee can be added back to your mortgage, not the penalty though, if you're uninsured.
I think one great point which has come out is that right now a lot of people, even with the fixed mortgages, are only having the 3-month penalty rather than the interest rate differential, right?
Right.
So, which might mean that there are a ton of savings possible with this reducing interest rates that are coming up in the 2025, right?
Absolutely. And you need to be on top of the game, on top of your game, right? Most lenders have not cut down their posted rates. That is why we are at 3 months of interest rate penalty, 3 months of interest penalty. This might change very soon. So if you are evaluating moving your mortgage from your existing lender to a lower rate, be it within the same lender or be it outside, to a different lender, you might have to act soon. We don't know how long these posted rates are going to be the same. As soon as they move, your 3 month interest penalty can double, can be 2.5x. We don't know. Every lender, it's a small window of opportunity if you're looking to move. And it only makes sense to move if your interest rate was upwards of 5.5% last year.
Right. So you got to act quick on this.
if you have to.
Yeah, of course. Okay. I think this has been a great conversation. I think this is really helpful, Jayant. The insights you have brought in, I know we couldn't present the case studies that you had, but again, I think we were able to summarize the scenarios really well. And if we have any other questions, I'll take it offline as well. A lot of people have been asking me this, and I think this is a great conversation. So if you, I know you also offer a free discovery call, right, with you, which is a
Right.
consultation, right? So I'll try to post that as well if someone wants to connect with you and have that assessment done on their mortgage, right? Is it going to make sense for them? What's going to the penalty look like? And what are the potential savings, basically, right? Penalty, maybe they can ask their lender and get the right information from there,
Yeah.
like what's it going to look like, the fees and everything. But the savings, that calculation can be done by you, right? Assessing their situation.
Yes. I've developed certain tools which I'm happy to share so
Mm.
that they can also. I believe in transparency. I create tools and I empower my clients.
Mm.
It's not like I'm holding the information.
Right.
I believe in sharing, and once this information is out there in the public, people can make better decisions.
Of course, sure. No, I've seen it. I've seen it with your calculator as well for first-time home buyers. I think that's a great tool as well. Something I like to present it to my clients as well. Just it helps do the calculations and they know the process. I think just filling the numbers with that, just know what all costs are associated and what they have to go through, right? So I think that's
Right.
a great starting point as well. So thank you so much for joining today. And I hope it made sense for everybody who were able to join and get this information. And I hope it helps a lot of people. Thank you.
Wonderful conversation, Harkiran.
Mm.
Let's try to get together again and discuss on another topic some other day.